Welcome, everyone, to our Let's See You Well event featuring Diane Hirschhorn. I'm seeing a lot of folks sign on. I'm seeing the numbers tick up pretty quickly. So let's all get settled and we'll welcome our guests and we'll get started in about one more minute. So, for those of you that are just arriving, Diane has a preference. If you don't mind, please turn your camera on. It just helps to be a little bit more engaging, community-based, and we can learn together. Right, Diane?
Yeah, I don't care what you do. You could walk away from your camera for a while. Like that doesn't offend me, but it's just much easier for me to teach to faces. I actually prefer teaching in person over Zoom. So if you could help me help you and keep your camera on, I'd super duper appreciate it.
Well, I see that we're 1 minute after the hour, and we do have a lot of great content for today. So I am going to get started, and we will welcome everyone else as they join us. So let me pop some information in the chat for you. So welcome. My name is Erin Cunningham Ritter, representing the College of Arts and Sciences Be Well program, and I am thrilled to welcome members of our CU community, including students, employees, and community members, to today's Let's See You Well event featuring Diane Hirschhorn, who will teach us a little bit more about financial wellness. I did pop in a link to the Let's See You Well webpage in the chat. This is the fourth installment of Diane sharing her knowledge with us. So if you want to catch up on the other workshops, the video recordings are in the Let's See Well link in the chat. So before we begin, please note that closed captioning is available by clicking on the live transcription button in the menu bar. Like I said before, this session will be recorded and we have built-in time at the end of today's session for questions, although you can raise your hand or put questions in the chat whenever you like. If you'd like to remain anonymous, you can always private chat me with your question. So we've asked participants to try and keep your questions more general as we move through the presentation. And then if we have time at the end, you can ask more personal questions. So now I am pleased to introduce our Let's See You Well Expert of the Month, Diane Hirschhorn, who is a lecturer of finance in the Leeds School of Business. She has over 20 years of wealth management experience as a financial advisor, providing complete wealth management strategies to clients. In addition to lecturing at CU Boulder, she is currently a consultant to financial institutions. And previously, she worked as a managing director at First Republic Bank and also at Merrill Lynch and Goldman Sachs. During her career as a wealth advisor, she received several industry awards, and at CU Boulder, she was the Marinus Smith Award recipient. Ms. Hirschhorn received a Bachelor of Arts degree in economics from Cornell University, an MBA from the Anderson School at UCLA. She is also a certified private wealth advisor. Now, without further ado, I'm pleased to introduce Diane Hirschhorn. Diane, take it away.
Thank you so much. And thank you for everyone who's coming for today. I know everybody's busy, especially at this time of the year, and I super appreciate it. I have a very casual style. And so please, as Erin said, if you have a question and it's in the middle of the presentation, either put it right in chat or raise your virtual hand and Erin will call on you. I'm happy to, like, this session is for you. So I really want it to be about whatever you want it to be about. And so I'm just going to turn to my prepared presentation and give you an overview of what ideally I'd like to talk about today. Um, and so when Erin was talking about my industry awards, like I just want to say for many years, my job was working with people who had $10 million minimum assets all the way up to $150 million or more. And so I realized one day that my real profession was helping rich people get richer. And I imagined myself as I was getting older, and I imagined myself like, well, what would they say on my gravestone? Like that rich people getting richer doesn't really have the ring to it that I wanted. So I sold my business and I thought I was going to retire. And then CU asked me to teach just one class in portfolio management. And I have to say, I love CU. It was totally unexpected how much I love teaching. And it's really my way of giving back, including this kind of presentation, because my goal overall is teaching people the tools, the tricks, the techniques that Wall Street uses. So you could either be more informed when you're talking to your investment advisor, or maybe you can do some of it on your own. My favorite award out of all the awards I got was the Smith Award because at CU they give that to faculty and staff members. It's a student nominated award. They give it to 20 people a year, and it's just to recognize people who are trying to make a difference in the lives of the students. So that really sounded a lot better to me than making rich people richer. So big disclaimer, basically, because I'm a paid consultant, I just have to say I'm not a financial advisor anymore. I'm very educated in the techniques that financial advisors and investment advisors use. But nothing I say should be constituted as investment advice. I don't know you personally, and I just want to make sure that you know it's not investment advice, tax advice, or estate planning advice, but hopefully I'm going to teach you a few things that maybe with a little bit more research you can implement. So as Erin said, we had two different lectures, actually three prior to this, but our main goal is to teach you today a little bit about what's happening in current markets. They've been a lot more volatile in the last 4 or 5 days. And to how do I start investing? So if you're someone who's super sophisticated, you're picking your own stocks, you know everything there is, this might not be the right lecture for you. For everybody else, my hope is that I can teach you enough so that you're comfortable. In some of our choices at CU for investing in other places. And then if we have time, I'd like to talk about this quandary that a lot of people have. Well, I have either some student debt or maybe some credit card debt or some mortgages, and I don't really understand, should I pay off those first or what do I pay off first? Or should I still be participating in my 401k at CU in addition to the 401a? And how do I make that decision? So this is a quick refresh. In each of the three lectures I've given, I always want to motivate people to think about financial independence and retiring early. So truly, my first job was working at Xerox. It was a miserable experience. I graduated in a recession and I was moving copiers literally door to door. Like there was no internet. That's how old I am. And there were 300-pound copiers that I just put on a hospital gurney. And then I had to like hope it didn't fall on my foot. I'm a klutz, so I was always worried about that. And then I would show up like rolling this hospital gurney with this enormous copier into someone's office and say, "Hey, I'm Diane. I work for Xerox. Do you need a copier?" That worked about as well as you can imagine, meaning it was an awful job. And that's where quickly I pivoted in from my background in finance. And I said, wow, I want to be financially independent. Like I cannot do this job for the rest of my life. And so that's really, I try to spend a lot of time trying to teach my students and hopefully a little bit for you all, like what is financial independence? And everybody can achieve it regardless of your income. I really was not making a lot of money at Xerox, and I very quickly was able to achieve financial independence. I'm going to teach you some of those skills today. So what it means is that your income and your assets are enough that they can provide income for you to live on. Now, I could have retired when I was 30 and a half. That's when I achieved financial independence. And I've worked ever since then because I'm super passionate about what I do. So people confuse retire with the idea that I stop working. And I just want to make it clear that retire just means I own my own time. My bills are covered by passive income. I donate or actually teach at CU now, but I just do it because I'm passionate about it. I mean, it's great that they pay me, but it's not the main reason why I'm teaching because my portfolio is doing the heavy lifting. It means that I eliminated debt, and I'd like you to do that too if you have it, including mortgage debt if possible. And then I have a safety net for emergency funds in case we go into kind of a brutal market. And that I can spend my time now doing things I really care about. Teaching for me, that's part of my work, but I don't have to anymore. Traveling, volunteering, really, or just relaxing if that's your game. And so I really give Erin and CU Be Fit, Be Well credit because they really are very interested in this subject of financial independence and how it ties back to wellness. It helps you like reducing stress and improve your overall quality of life and health outcomes when you no longer have to worry about finances. You gain control of your time, and then it creates long and lasting stability. So I wanted to begin by just pivoting slightly and just talking about the market update, just because like the timing of this lecture, we've had 4 days in a row of volatility, and there's a lot of news in a very big book right now, literally big, 1929, talking about some of historic volatility and then tying it back to today. So I wanted to just talk and say, really, this is just an opinion only. And it doesn't mean that the market is going to do anything. Never trust anyone who's a soothsayer or forecaster. And this is very confusing for people because, CNBC, the Wall Street Journal, like countless blogs, TikTok, we are barraged with information with all these people telling us what's going to happen next. No one knows that's the reality. And I have learned that I can make money in the market over long periods of time, regardless of what's going to happen tomorrow. And so this is not really a forecast of what's going to happen tomorrow, but rather it just things to me and my sniff test for investing. It just seems like a very expensive market right now. It seems to me that there may be some room in the short run, but I really wouldn't be surprised if we have a reunion and it's 10 years from now or even five, and there hasn't been some sort of market correction. I think we've been lulled into this false sense of security in the last, really, since 2008. The market has had this unprecedented bull run, which means it's gone up. Since the bear market of 2008, that means a down market until now. Now, there was a correction from 2020 because of COVID, but that just was so fast, really fast down, really fast up. I just don't even consider that like in my analysis of what happens generally in the market because a bear market is hard. For those of you who are my age, you know what 2008 was like. You remember what to 2002. And when I look just at numbers, and I'm not emotional about this, I can see there are various metrics that basically suggest if I look at the latest averages, and we don't have time to go into each of these, and compare it to the 30-year average, in each of these cases, I see that they're signaling that the market is expensive. And just because it's expensive doesn't mean it instantly corrects. It's been expensive for a while, but for me and my perspective, I feel like it's starting to get closer to some of the valuations issues we saw in the internet bubble in 2000 to 2002, or really in the late 90s. The correction was 2000 to 2002, but the late 90s is when it was. And for all of my students in my classes who say to me, Diane, oh, come on, you're old. Haven't you heard about this new technology, Diane? And it's called AI. And don't you understand that's going to revolutionize the way business is going to be done? And I say to them, indeed, I think you're totally right. It is revolutionizing business. It's going to have an impact on my kids and us and maybe like some of the jobs out there. And then the available, it will replace plenty of jobs. At the same time, I say to them, hey, Ask your parents about the late 1990s because there was this new technology. I'm sure you've never heard about it. It was called the internet. It was going to revolutionize the way businesses took place. It was going to like make things easier to buy and sell. It did all of that. Research all of it. Except reality came. And just because it's an amazing technology doesn't mean I'm willing to pay any price for it. And I think that there's a little confusion right now on what is a fair price for either AI or for the US stock market in general. And so that's really the main thing I'd like you to get out of this chart that to me, it reminds me a little bit of two markets, 2000, right? Because stocks were super expensive. And the second thing it reminds me of is the 2008 crisis, because for those who are investing then, you'll remember that was led by a debt crisis. And if you learn or want to read about the history of the stock markets, many of the corrections have occurred because of debt crises. And I really think that that may be happening now. And for anyone who has done, like who reads the New York Times, there was a great article, I don't know, sometime in the last month, and they were quoting Jamie Dimon, who runs JP Morgan. And basically, he said, there are a bunch of cockroaches right now in the credited bonds, like lending. And what he meant is when you see one cockroach, the problem is they're rarely in a New York City apartment by themselves. They have a lot of friends. And so what he was saying is that's similar to what he's seeing and what many people are seeing in the debt markets right now. There were two major bankruptcies within the last month. One was a used car retailer, and the other one was an auto parts maker. What's significant is that it exposed some of these hidden forms of debt, maybe some fraud, and maybe there could be contagion. Maybe it won't happen yet. But what's really happened over the past 10 years is you probably have some friends who've said to you, oh, well, we should be participating in some of these private credit funds. You can even do it not at CU, but in a bunch of 401k plans. And this is a little disconcerting because what's happened is our public markets, banks, investment banks, they're highly regulated. And so that means there are a bunch of laws that help honestly protect the consumer ultimately. And so the fact that all of this is hidden now, I don't really know, nor does anyone, how much of this like potentially bad debt is out there. And so I think the combination between maybe there could be some bad loans and bad debt, maybe we could get some more defaults. We're even seeing it in things like car loans right now. There's more delays or delinquencies in car loans. And I think if you combine maybe some structural issues with debt, maybe with some overvaluation, I just would be surprised if we have a reunion in a few years and something hasn't happened, but I could be wrong. Having said that, and I'm not the only one, by the way, like there's plenty of very smart people who are sounding the alarms. But having said that, I want to assure you, I have not personally sold any of my stocks. In going into a market like this, I have this one client, and every time, like I actually talk to clients much more when I thought things were shaky, when they may go down, and when they were down. Because when things are going up, like everybody is happy. But my job in part was to prevent people from panicking, from selling when things got a little scary. And so he used to say to me, oh, are you telling me right now, if you're calling, are you saying I'm going on a roller coaster and I should put on my seatbelt? And I really like that analogy because I think we all need a seatbelt coming up. It doesn't mean that we should sell.
Hey, Diane, if I can jump in because there's a pretty relevant question before we pivot. Ben asks, how big is your safety net? Should we shoot for sitting out 2 years of a bear market, assuming we're living primarily off investments?
Okay, wait. So should you how big is the safety net? And you're suggesting, Ben, should it be 2 years of savings? Is that correct? Is that what you're suggesting? Well, I don't
Yeah, I mean, if somebody's near retirement or in retirement, so they have maybe a smaller fixed income, like you kind of said you have a safety net in case there's a bear market or other emergencies. So I'm just curious your thinking on that.
Yeah, okay. So is it going to be, it's an awesome question, and I need to divide it if I'm closer to retirement or I'm just starting. Okay, so if I'm just starting, I would say you need a much smaller safety net. The guidelines, the rule of thumb is have 3 to 6 months of spending needs. And I actually tell my undergraduates that comes at a huge cost. Same thing for my kids. I have a 22-year-old and a 24-year-old because there's a big opportunity cost if they have to save, let's say, 3 months or 6 months of living expenses. That's what's called a big cash drag, meaning if equities normally go up about historically 10% per year, cash right now, if you're really smart, maybe you're earning 3 to 4%. A lot of people earning nothing on their bank accounts. And so for my kids, I suggested you need a lot less than that because they essentially, if you're at the beginning portion of your career, they are bonds, right? Like they will continue to make money. And if they need enough to cover, I don't know, a month's rent payment is my advice to them because I said, look, we know, Dad and I, that you are earning money and you're very disciplined about savings. And so for them, I said, hey, like you could always temporarily you lose your job, you could borrow from the bank of mom and dad for a few months. Frankly, for other people, they could also borrow from credit cards, and then they wouldn't have this cash drag. So that's for super young. And then at the other end of the spectrum is what Ben was referring to. Suppose I'm right before retirement. And this is somewhat subjective. You won't like that as an answer, but that is true. And so I like the idea of really for me, I'm old. I want to sleep well at night. And so I want to know, I always think of these draconian situations. I'm fired from CE, so I have no income anymore. My money, my portfolio, I never want to liquidate or sell from my portfolio when it's down, because that effectively is killing a golden goose. So, Ben, my answer would be I would kind of figure out like what number is enough to help you sleep at night. And how I might do that is I would say, how much am I earning in dividends from my my stock portfolio? And how much am I earning in interest from my bond portfolio? And when will I collect Social Security? Because those three things will give me a form of income. And I said to my kids and my students, you almost don't want to, like, I don't need to put aside, let's say, 3 years for me of spending, right? Or income because I'm not spending everything that I earn. So I kind of just figure out what is the bare minimum I need. Like I own my house. I need to cover my utilities, my food. And so for me personally, my risk profile, because I've been through a number of these, I actually want what's called a short-term spending ladder. Like, I want to have, like, in my case, I have 3 years, this is very personal, but spending that is set aside, but I have it in what's called a tips ladder. So this is such an important question. And so it's basically I have purchased inflation protected bonds. Essentially, it's part of my bond portfolio. So that no matter what, I just know like the world could blow up separate from politics and everything else. And I have an asset that's going to cover some of my spending, not everything. I'm not putting vacation money in there, but my basic spending so that I can ride out some volatility. That's really how I figured it out. I'm happy to elaborate on this subject later because it's a little bit of a hard question. Is that good enough for you? Okay, great. Sorry, that was a much longer answer than you expected, but the one tricky thing about this presentation is I have a wide variety of people. Some people on this call, some people who are at the beginning of their careers, and some people like me who are or more toward the end. Okay, so I don't know why this is not showing as a slideshow. Give me one sec. So sorry.
Your cursor is close. It's right one. Yep,
Okay. Can you see that now?
looks great.
Okay, great. Sorry about that. Okay, why do I even need to listen to this? Why do I even need to invest? Because those people, like I say to my students, if you're on the younger side, and even if you're older, you should be saving at least 20% of your income after tax. And most financial advisors are going to tell you save 5 or 10%. And I promise you, I have my students work on a spreadsheet. The math doesn't work out. It will not work out. You will have to, like, you don't want to be living ultimately on just Social Security. If you're working at CU, your after tax income is higher than whatever your Social Security payment is. And so, like, the idea is let's just say Ashley, there are two twins. Ashley is spending $4,000 a month of her like income from CU. And at 65, she doesn't really save something, or she saves very little. And so she only has $2,000 a month in Social Security in that situation. And then the problem then is that she's used to spending 4,000. So that's just a huge lifestyle change for her. And instead, if she had just saved 20%, which is $800 in this example, she'd have a net worth of $2 million. And then with Social Security, she's living off of $150,000 a year using conservative return assumptions. This presentation is filled with books because I want to give you resources of places you can turn to, so you can become independent without having to listen to me lecture. So I love this book. It's by J.L. Collins. He also has a great blog that's called jlcollins.com. He doesn't post as much lately, but he does post and he's just great. So he basically had three simple rules, which I use all the time. Like, number one, you want to become wealthy, spend less than you earn, then invest the difference. And we're going to talk about how to do this and avoid debt. It is really not hard. Like, there's this desire in human for complexity. And so we want to invest in all these elaborate get rich quick schemes. In my opinion, they never work. And so I'm going to talk about simple things that you can use that CU has as resources. Okay, Nick Majuli has he has a blog that's called Dollars and Data. Dollars and Data. And recommending several different sources. I have to say, almost all the advice out there is horrible. So please be very careful with what sources you use. But I vetted these and I can tell you Nick is great. He also wrote a fantastic book. He's written two. But my favorite is called Just Keep Buying. And he has all these fantastic suggestions in there. And Nick, one of his comments, which I thought was so smart, is he said, you know what? People obsess over the best investment and how do I find it? And they always want to get an edge and do a little better than their neighbors. And he basically said, for most people, that's misguided. Why? Suppose I'm a brilliant investor and I have $1,000. I have like $1,000 that I put in an investment account, and potentially I earn a 10% return, right? It really is going to only net me an additional $100. And he says for the bulk of our careers, we should also really focus on this savings component because all of us on this call have spent at least $100 in the last month that we kind of regret now. And so if you focus instead of this, like, I have to optimize my investments, I'm going to show you how to do that. But instead, focus also on saving and then investing because these things are in our control. Okay, so now I want to go over some of the basic investment choices that are going to be offered to us at CU within our 401k plans, 401as, and other options. And so, basic language here. What's a mutual fund? So here's the strange thing to me. Most people can't even tell me exactly what a mutual fund is. They can't really tell me what an index fund or an ETF is. And one of my rules for investing for my clients is never invest in anything you cannot explain to your kids or to your friends or to your parents. Because when you don't understand it, if it's a black box, when the markets go down, you will panic and sell it. And I like one of my favorite stories is I had a client, this is in early 2000s. He was a super famous um well, he was a very well-known, let me say, venture capitalist, someone who invests in private companies. But before that, his job originally was he was a partner at a big four accounting firm, very smart guy, very mathematical. Then he was the CFO of a major, let's say, top 50 companies in the US, major Fortune 500 company. So this is a guy who really knows math. And I'm meeting with him initially, and I see he's given me all of his asset statements to analyze. And I see this statement, and this is before Madoff, so you know where the story's going. And it's a blank piece of paper from a hedge fund, and it simply shows his account balance. And he says, "Oh, I love this. You could take, let's say he's worth, I don't remember, let's say 75 or 80 million dollars at this point, and he has maybe $3 million dollars in this hedge fund." And he said, "Diane, you can have everything, but not this one hedge fund." Why? Because it goes up every quarter, Diane. Every quarter, no matter what it is, I get a statement. Doesn't matter if the market's up or if the market's down, it gives me consistent returns. So this is probably in 2002 or 2003. So we have already gone through a horrible market. And I say to him, let's call him Bob. Bob, this just doesn't meet my sniff test. I don't get it. What do they do? Well, he doesn't understand, even though he's super smart, he does not understand what this fund does. And I say, well, it just is not behaving like any investment I have ever seen. So, P.S., 2 years later, he calls me and he says, "Hey, like they call me, they have this amazing opportunity for me to invest another $2 million." So you could just see where this story's going. I say, "Bob, sure, you could do it. But I have never seen a really great hedge fund that calls clients saying, please invest more." So for fast forward a couple more years, and this whole thing was an enormous Ponzi scheme. And he didn't fundamentally understand what he was invested in. And so this happens to the rich and the famous, as well as you and me. And so, backing up to a few basic terms, the mutual funds we see in our 401(k) plan is just a bunch of people mutually contribute money into a fund. And that fund has, unbeknownst to most people, a manager. And that manager is picking stocks, that's or bonds or whatever it is. And so what is an index fund is a specific type of index of mutual fund. And instead of picking whatever stock they think is going to do the best or bond, they just stick with the index. So an example of an index is the S&P 500, the Dow Jones Industrial Average, and so forth. And so their mandate is simply perform as well as the index, as the benchmark. Why would you do this? Because it's very diversified, because it's low cost, and because they have a good track record. So I want to build on this concept because I have a bunch of students, especially my MBA students, and even my undergrads who will say to me, "Diane, like, why would you ever want to own an index fund? Don't you understand, Diane, that I have invested in Nvidia or I don't know, Tesla or whatever the stock of the day is, and I have made a lot of money." No doubt there's a few students in the class who have been lucky, and that's what I say to them. Because if I look at, I'm not smart enough. In fact, almost all managers are not smart enough to tell you which are the companies that are going to outperform in the next decade. And so I am very happy to invest my clients' money and do as well as the index. And I'm going to build a case for it in a moment. And the best thing I can show you is this is a combination of this top 10 companies in the S&P 500 by decade from 2000 and, 1985, 95, and so forth. And the colors, I'm sure it's hard to see on your computers, but what you would see is the composition has dramatically changed. So I don't need to be smart enough to figure out what are the top 10 companies that are going to be the leaders in 2035 because I own them already. I just own the market. And this is a very effective technique. So if I were to just look at performance numbers in a 20-year period, which is the longer the time period, the more predictable, I can see that between almost 90% to 94% of all active managers, of all mutual funds that are in index funds, underperform. They underperform their index. So this is just my opinion only, a crime, because we convince all of these investors, you need these special managers because they're going to outperform, and they don't. In fact, the data is much worse than this slide will show. Why? Most mutual funds aren't around for 20 years. They go out of business because they don't perform well. So these are only, there's survivorship bias. This data only includes mutual funds that actually survive for 20 years. So I had great comfort telling my clients, hey, let's just do them, invest the money in index funds because we are going to be in the top few percent of all investors out there. And then that left my clients wondering, well, which index fund should I invest in? There's so many of them. So this information, I have to be very careful, huge disclaimer, because I can't give you investment advice. So I tried to find a source that I really trust. Mike Piper wrote a book called, he's written many books. I'm going to give you a link to one of them in just a few slides called Investing Made Simple. It's 100 pages or a lot or less. He's fantastic. And his website is called The Oblivious Investor. He doesn't make any money from providing this kind of advice. He does make money from selling his books, but that he's just trying to level the playing field and talk about what I would call the investing truth. So on his website, again, I give you a link to it, obliviousinvestor.com. He has 8 sample portfolios, and it's either do you want to invest in one fund or do you want to invest in up to 8? And so I've just copied this for you right here. And what he nicely does, if you want to invest in one fund, here's 2 choices. If you want to invest in 2 funds, it's a combination of these 2 funds and so forth. And he gives you, so that's why I could repeat it, either the index fund or the ETF, the symbol of either of them. They're both essentially the same. An ETF is an index fund that is, it's a single stock that trades exactly like an index fund. So either of these would be fine. And on his website, he divides it up into how complicated do you want the portfolio? Do you want one investment or do you want 8? And he does this, and he has all over his website saying this, hey, like, I'm going to make this for a hypothetical person who has 70% equities and 30% bonds. You may not want that allocation. So what should you do? Just adjust it on a pro rata basis. And then he also does the exact same thing if you have your account at Fidelity. I don't care where you have your investing account. You have one at CU. For most of us, we need another account. I happen to really like 3 firms, Vanguard, Fidelity, and Schwab. And so that does, I'm not affiliated with any of them. I'm not endorsing them. Please do your research. But those 3 firms charge a lot less And so ultimately, the fees come right off your return, and I'll show you that in just a minute. So it's not me specifically recommending this. I'm giving you a link to both a fantastic book that will describe this strategy and also his website, obliviousinvestor.com. But that's just so much to absorb. It's confusing, even for people like me and for Erin. It's just like, how do I figure this out? I'm still like, this is just a few minute lecture. I don't really know what I should do. Um, should I maybe follow this strategy? I don't know you. I don't trust you. What should I do? So, first of all, I would say knowledge is power. Like, I would never follow what I say, what anyone says, without vetting the information, right? And I would read as much as I could because if I understand it, just back to that client example, if I understood it, if he understood it, he wouldn't have ever, he lost his money in that. Like, don't feel too sorry for him. He's worth super, like, just tons and tons of money. And he learned his lesson. But you really, really want to get comfortable. And I know a lot of my students say, but I'm not so familiar with math, or maybe I am. It doesn't really matter. These concepts anyone can understand. And so for most people, the best combination, the best portfolio probably has three funds, right? I'm going to build on that and limit it to one in a minute. One that's a US stock fund, one that's an international index fund, and one that's a bond fund. And so I a lot of times have students right now who say to me, Diane, don't you understand bonds hardly yield anything? Why would I ever want those? And they will also say to me, Diane, international stocks, like the US is all where it's at. I would never want to invest internationally. So I tell those students, number one, bonds, even my own kids, I recommended they have a tiny allocation because they're 22 and 24 to bonds. You want an investment that zigs when the market zags. You will feel better that you had not everything, all your eggs in one basket. You're always better off on a risk adjusted basis, having even a small allocation. And the older I am, probably the more I want in bonds. For international, I tell my students, like, this is recency. It's a bias that just because the US did well for the last, I don't know, 10 plus years, eventually asset classes return to a mean. In international this year actually has gone up more than US stocks. That's not why I own it. I just want a diversified portfolio. I'm not smart enough to say in 50 years from now, my kids inherit this money. Will the US be dominant still? Will some other country? But I own them both. I own them both, so I don't have to be smart enough. So, to simplify things even more, see you and most of you who are married and have spouses, most 401k plans also have something called a target date fund. And what a target date fund is it does all the work for you. You don't have to buy the three funds. You don't have to buy five. You don't have to buy seven. So you're saving or investing toward a target, a date. So it would be every 5 years. There could be one for 2025, 30, 35, and so forth. And the fund itself adjusts the bond allocation for you and the international. So I don't have to anymore, completely hands off. And so it helps investors, in my experience, as long as it's low fee. And CU, I'm going to show you, is very low fee. And I'll show you how to look at it on your spouse's plans too. Very low fee. And so essentially, what it's doing is it for less than a tenth of 1% is the fee. That's super low. It's picking a combination of stocks, not stocks, index funds, international, and bonds for me. And as I age, when I'm very young, it's almost all stocks. And as I get older, it buys more bonds for me. So I don't have to make a decision. Why do I think this helps people? When there are various behavioral biases that lead people to make mistakes in investing in a lot of different things, right? And so as a result, Like we often don't like my students right now. I just had them build my MBA students like a path toward retirement, and the amount of money that they all put in bonds was almost nothing to get to age 65. Like that just doesn't work. Like go ask your parents what percent they have in bonds right before, like back to Ben's question, if it's the day right before I retire and I have all my money in stocks, then I'm putting all my eggs in a very risky basket. And so this is the definition of target date funds, which I just went over with you. I just want to talk for 5 more minutes before we open up to Q&A. And so within CU's 401k plan, you can see that this is an example of one, a 2040 target date fund. So what it would look like is maybe I would pick this if I wanted to retire in I guess 15 years from now, but it could be 2025, 30, all the way up to 2075. So I pick the date that I'm thinking is when I'm going, not exactly the date within a 5-year band, and the fees you can see are 6/100th of a percent. So 0.06%. And fees are so important to control. And this is an amazing plan for CU to offer its employees because in days, I don't know, 15 years ago, when they used to have these target date funds, it was another way of the mutual fund industry to confuse us and to load us with fees. But this plan is really very low fee and it uses index funds within it. And you can see that this is just a quick snapshot of a choice right from CU's plan. This is the most recent date that they update it. They update every quarterly, but you can see it's in the Russell 1000 index, that's US large cap stocks, international index, and then bonds. And so I think this is just a one-stop shop. Like you just could forget everything I said up until this point. And if you want to keep it simple, I'm not giving you investment advice. You should read this book, Investing Made Simple, because it's 100 pages. You owe it to yourself. And he'll explain what a target date fund is. That's Mike Piper. And then here's an example of like a little more details. So sorry, you guys. I just lost my page. Okay. Little more detail of like what it might look like on CU's website. Again, this is just a different plan. This is the 2065, just as an example. If I were younger, it has a lot more in stocks. That makes sense. When you're younger, you can take more risk. If I'm working outside of like CU or I have a spouse and we're planning for a retirement, these target date funds sound like a good idea. That's what some people are thinking. So here's just a page right off of Vanguard's website. I'm not endorsing it, but they're very low fee. They're very low fee. So I think their investment objectives align for most investors. But maybe it could be Fidelity, maybe it could be Schwab. There are plenty of firms that have these. How do I know it's a target date fund? Again, at Vanguard, they label it target date funds. These are all the samples of some of the years. They actually go out longer than this. What do I care about? I would definitely screen for low fees. So I would want my fees to be 1/10 of 1% or less, 0.1% or less. This is 0.08%. Those are excellent, excellent fees. And so I'm hiring someone. It's as if I've hired a coach to help me plan my retirement, and it's a one-stop shop. You would find something very similar, by the way, at Fidelity, Schwab, and so forth. But I want my advice again, this isn't investment advice. Screen for fees and make sure that it's an index fund. Why? You're just more likely to outperform that way or to at least perform as well as the benchmark. And I want to close with two other slides. And so this one shows the average performance of the average investor in the United States, okay? 2.9%, who, by the way, is invested in all of these other asset classes, like the S&P 500, like bonds, small cap stocks, and so forth. So why does the average investor in the United States do so poorly? They're overwhelmed with all the investment choices. They feel really badly when markets go down. And so the average investor buys high, sells low. And what we want to do is buy low, sell high. And so if I put or automate my investments, so every month I'm participating in things like either a target date fund or an index fund, I'll probably skew my portfolio if I can understand it so it does outperform. And the last slide I want to leave you with is people get so hung up in, is it a target date fund that I should invest in? Should I invest in index funds or mutual funds? And so the very, very, very biggest performance, like what's going to really determine your portfolio return is how much I put in, like percent I put in stocks, the percent I put in bonds, the percent I put in cash, crypto, or something else. Why? If we just think about the return, average return, stocks generally return on average 10% per year. Bonds might do 3 or 4%. Cash for most people earns almost nothing. So, what matters a lot more than which fund I pick is what percent I allocate to different strategies. And then from the previous slide, can I stick with it? So that is really, I could talk forever, but that is all I have for you for now. And I want to open it up, be mindful of everybody's time and be open it up for Q&A.
Yep, we've got some questions rolling in. So Allison, I know I mentioned that Diane would talk about Roth accounts, but we might save that in
We'll have to
more
say that
depth
for
for a
next time.
future. Yeah,
Yeah.
we'll do
All
more.
right.
But her question is, for someone within a few years of retirement, what is the best way to decide if doing Roth conversions is a good idea?
It's a very tricky question. And so, like, essentially, let me just give you a basic definitional difference. A like a traditional 401k plan and a Roth. Same thing for a traditional IRA and a Roth IRA. The only difference is when do I pay the tax? Both places I pay the taxes, but a Roth, I pay the taxes upfront, never pay them again. Okay. So that's a fantastic investment vehicle because what it means is I pay it at my rate and I never pay any taxes as the investment is growing, growing, growing. And then I want to distribute when I retire, I don't pay taxes. So that is Roth 401k, Roth IRA. And in contrast, there's something called traditional. At CU and in most plans, they don't call it traditional. Okay. It's just our regular 401k plan or a regular IRA versus Roth, but the real name for it is traditional. So some firms may label it traditional, some firms may have no label. But if there's no label, it's traditional. So in traditional plans, I pay the tax later. Roth, pay tax now, never paid again. Traditional, I don't pay the taxes up front. It reduces my ordinary income tax obligation for the year I contribute. And then it grows, it grows, it grows, it grows. And then upon distribution, I don't pay taxes. I pay taxes, sorry. So Roth, pay taxes once, never pay taxes again. Traditional, don't pay taxes now, grows, grows, grows. And then pay taxes upon distribution when I take out the payments for it. Okay, the RMDs. So how do I figure out which one to do? And this is related to right before like retirement with conversions too. It's what is my tax rate now? And what do I think my tax rate's going to be at retirement? So I say to my students, if you're at the beginning of your career or if you're at a low tax rate, then probably it makes sense to pay taxes now, do a Roth. Because low taxes now, my income and my assets grow, probably my tax rate grows, and I've already paid the taxes at a low rate, I never paid again. Conversely, if I'm making a lot, I'm in my 50s, and between my spouse and I, we're, I don't know, paying 32%, something like that in our federal taxes, something like that, then maybe, depending upon my assets, My tax, I'd rather not pay the taxes now, do traditional because my income is higher, my tax rate's higher. And when I make distributions or RMDs, my tax rate is lower. So that's the distinction. Do I do it a Roth conversion? I would talk to your accountant and you want to understand what is my tax rate now. If my tax rate is really high, probably doesn't make sense to do a Roth conversion if I think it's going to be lower when I retire. Maybe when I retire and I'm not working anymore at CU, probably my income and my tax rate is lower. And maybe it makes sense to do either a Roth conversion or a partial Roth conversion then. There's a really good resource for this. Investopedia, I find generally to be a reliable source. So, Investopedia, you could look at partial Roth conversion and Roth conversion. There's also another website, it's a blog called The White Coat Investor. And he also has a very good discussion of uh, Roth conversion and partial Roth conversion. It's actually targeted toward physicians, but it's a great website. So those would both be good sources. The last one is Oblivious Investor, but it's an important question, and I'd really get the information correct. Accountant plus my own research before I started it. Erin, next question.
Awesome. Okay. Question speed round. Kayla asked for saving for a down payment on a home. All the advice seems to say that if you plan to buy in the next 3 to 5 years, you should have that in high yield savings accounts, not investments. It sounds like you might have other advice, for example, not having this as a cash drag.
No, that's different. Okay. The reason why is no, I agree with the general advice. In fact, this is related to Ben's question from much earlier. It's cash I might need. If I need cash in 3 years or less, my rule of thumb is it should not be invested in equities or stocks, really, because that's money that might go down. It's important for me to maintain that. So I think cash, high yield cash is a fine place. CDs would be a fine place. There's something called a Treasury inflation protected bond. All three of those would be a fine place. Also, T-bills. All of those are fine choices if short-term cash needs. Next.
Okay, I'm just going to pause and say we've got just a couple minutes here, but we do have quite a few questions coming through the chat. So want to be mindful of everyone's time. If you have to sign off, totally understand. But Diane has graciously agreed to stay on for about 10 extra minutes. So if you'd like to ask questions and hang out, we would certainly welcome that. So thank
Also,
you.
everybody, if you want to send Erin a note of any other topics you want me to cover next time, I'd be delighted to cover them. Okay, Erin, go ahead.
Yeah. Okay. So Jennifer asks, I was told to invest some funds in a government money market fund to protect against volatility. Is a good money market safe in the government, if the government is in transition?
Yeah, so that I'm never going to say something safe or not safe, right? But what I would say is I would only keep my generally it's not something I would worry about. If you are concerned with the safety of your assets, I would invest in like a bank that has FDIC insurance. Almost all banks have FDIC insurance, and that covers each of us. Each social security number, so my husband and I together could have up to $500,000. We don't, but at a bank. And so, and that would cover you. I also think, like, for people who are worried about treasuries or anything affiliated with the US government, I think it's unlikely that the US government can't promise it, but very unlikely that they would default. Why? We don't have a currency that's tied to gold anymore. So the government can always issue more cash. They can always print more cash. We might go into a high inflationary period, but print more cash to pay back debt holders. So it's not something that keeps me awake at night worrying about. If you really, really do want to just do business with a bank that has FDIC insurance and then you're covered. Either that or you could buy like treasuries or really yeah, from the US government
Okay.
directly. And I think extremely low chance of default. Possible, but very unlikely, yes.
Thanks, Diane. Allison asks, you opened with talking about eliminating debt. even if a house mortgage is at an interest rate of 3.5%, do you still recommend paying off the mortgage? And if so, why?
Yeah, that's a great question. And we are going to talk about this in our next lecture in March. How do I decide if I should pay off debt and in what order, like credit card debt, mortgage? In yours, or do I invest? In your specific example, was it a 3.5%
Yes.
so for the interest of like the US government gives us the ability to deduct like the interest payments up to the first on the interest on the first $750,000 worth of debt. That is a huge benefit. So that 3.5% mortgage is very low, very low. My guess is it's probably a little bit below 3% after tax. Okay, is how much you're paying. So the way I would figure this out is I'd say, what else could I invest in that is essentially guaranteed that I could get a greater rate of return than my cost of my mortgage? Cost of my mortgage essentially, let's say it's between 2.5% and 3% after tax. I think that's a reasonable bet that over, I don't know, a 30-year period, I could probably earn a greater rate of return than my mortgage debt. When I was talking about not for everybody, like for today, mortgage rates are probably around 6%. That's a pretty hard bar to get a guaranteed rate of return that's higher than that. So the higher your cost of your mortgage, the more likely it is that I think you should consider paying it off early. Having said all of that, I still paid off my mortgage early. Why? Like I'm back to the example with Ben at the beginning. I want to sleep at night. So like the market could go to 90% fall. I still own my house, right? I just have to cover my you know, like electricity, my food. That's just a pretty low bar. So I think there are other reasons why some people may want to consider slowly paying off their loans. If your mortgage is at 6 or 7 or higher, I think interest rates may come down. And as they do, I would look at refinancing to lower the cost of it. Erin, next.
Great. No more questions in the chat, but feel free to add questions or even raise your hand and come off mute and ask Diane. While you're thinking about it, if there's topics for future workshops, would love it if you would add those in the chat. If there's specific topics you'd love for us to cover, we can try and work that into our planning. So in the
Nothing.
mean, yep.
We've got no questions. I always say this to my students, like happy, happy, happy to answer them. We've got nothing that's worrying you.
While you're noodling on your questions, let's show Diane a little bit of love. I am in awe every time she presents, the way she can share complex topics in such an accessible way. You're a CU treasure, and we're so happy to have you.
You guys, it means so much to me, but Erin is like the nicest and best ever because she contacted me long ago and she's definitely on a mission to help the employees and at CU live a better life. All of her lectures are great personally, but also I really love this. So thank you for the love because it's why I teach. It's really to try to make a difference. Wall Street, I hate to say it, it's not really on your side. It's on the side of making maximum profits for themselves. And so it's always like buyer beware. It's the strangest relationship that investment advisors may or may not have with their clients because unless your investment advisor is what's called a fiduciary, they don't need to prioritize your best interests at heart. Like I just don't even understand how this could be possible.
Well, and Diane, we've got a question popping up in the chat that is related to that. Hannah asks, I'm always hesitant to work with a financial advisor. I feel it's so hard to trust them. Any tips on picking slash working with one?
Yeah, Hannah, can you send that to Erin? And I'm going to cover that.
Okay.
I so am in the next lecture, how to hire someone. So I am so proud of you for being skeptical because I have seen it all. I have seen all of the good and the bad and the ugly. And by the way, the bad and the ugly, I'm sorry to say this, massively outweighs the good. And so because there's just so I don't think that most investment advisors wake up in the morning and say, how do I do the worst job for clients? Except that the compensation and the structures are really not perfectly aligned, in my opinion, with what is best for a client. So I would understand things like the fee structure um, that they charge. It's just so there are many, many things. Here's a quick thing to do. There's an article by someone who writes for the Wall Street Journal. His name is Jason Zweig, Zweig. He writes a column for the Wall Street Journal. You can get access to the Wall Street Journal for free at CU. So I'd subscribe for free and look at his back data. And he has, I don't know, within the last 5 or 10 years, an article about how to find an investment advisor. Jason is amazing. And he's one of the few people I really do follow. And he has a great article and he'll give you a whole bunch of questions to ask.
Okay, we do have some coming through, so let's get back to the speed round. I'm going to jump around a little bit because Allison asked a follow-up question to the last question you just answered, which is, what do you think about the financial advisors that solicit business via free dinners, etc.?
It's a little bit, I'm sorry, Allison, they could be great people. Okay. They could be great people, but this is a little bit similar to me, to my client who they was suddenly contacted by the hedge fund. Oh, this is just a great opportunity for you to invest. Like, what's the chance? Like free dinner, like great. You could go for the free dinner. Please don't confuse a free dinner with great investment advice. You need to vet it. Really, I'm going to just recommend once again, this Investing Made Simple, just because it's 100 pages or less. And also the book I recommended by J.L. Collins, which was A Simple Path to Wealth. Please read those first. The reality is, most of us could do a really good job if we're confident and we learn it and get comfortable on our own. Some of us would really benefit from an investment advisor, but I would be skeptical first. Dinner doesn't persuade me one bit. Erin.
All right, thank you. Ben asks, 95% of investment advice is about saving, very little about spending. How to avoid sequence of returns risk would be a good topic, I think. So we'll add that.
Okay.
And then Lisa asks, I have a large amount in a bank just for my own peace of mind. Why would a bond fund be better than a bank where I can get 3.6%?
Because the 3 point, first of all, it may not be better. It may be better for you personally. Everybody has to make their own choices. The 3.6% is not a guaranteed rate of return. In fact, if you looked at your return a year ago, it's probably a little higher. And my best guess, no, not forecasting, my best guess is if we were to meet again in a year from now, I think interest rates might be lower. And so that 3.6% isn't guaranteed. It may go lower. It's set, reset potentially daily. And if I bought something like a short term bond fund, not a long term one, a short term, maybe treasury fund, maybe something like that at a firm like Vanguard, I lock in interest rates for a long, potentially longer period of time. Another way to do it is you could buy a bond right directly from the US government. No taxes, I mean, sorry, taxes, but no commission involved, and also guarantee that you'll make a certain amount. Same thing, you could get a CD anywhere from 3 months up to 5 years that would guarantee or lock in that rate. So it's just how much cash do you want? When do you need it? Right? Because if you need the money in like the house payment question a month from now or 3 years from now, you really don't want to buy a longer term bond, right? So it's you need to understand more about bonds before investing in it. That's all I would say. But it might be the right answer, or maybe cash is the right answer. Erin.
Good. It looks like we're caught up in the chat. If anyone wants the recording directly, I'm happy to email it to you. You can just pop me a note. Otherwise, we are going to add this to our collection on the Be Well website, and then the webpage is Let's You Well, which will include all of
Great.
Mother's
And
Day
Erin,
today.
can we include the disclaimer again that everything this is just educational, no investment advice? Like, so you put that
This
in.
is for your educational purposes,
No,
everyone.
no.
This does not constitute investing
No,
advice.
just for the replay. Just for
Yes.
the replay. You had a slide just to help with that.
Yes.
Thank you, everyone. It's such a pleasure. If you have any other questions, or you want any other topics, please reach out to Erin and give her ideas. Your support is really great, and we would love to sponsor these by making sure we talk about the topics you're most interested in. So please let us know.
All right.
Thanks so much.
Um, awesome. I'm seeing lots of love coming your way once again and seeing notes. Jane, yes, I see. I'm happy to send you the recording. Christine, yes, recording, and Nee as well. I'll add you to the list of recordings. Okay.
Thank
Wow, we
you.
covered so much.
So kind of you. Much
Yeah,
appreciated.
absolutely. Well, thanks everyone for joining us and be on the lookout for the next presentation in the spring. Take care, everybody. I'm seeing all these requests, so I'm taking notes. Yep, got it. Okay.
Great.
All
Bye.
right. Well, let's sign off and we'll chat soon.
Great. Bye.
Bye.